Let's start with the data in the United States of America. Since you've been speaking this afternoon, we've got another read on core inflation, 1.9%, the least since October 2015. The break-evens are beginning just to dip quite aggressively, the expectations of inflation. We've written an article, is this the goodbye to inflation, or is that too harsh?
Well, I haven't had a chance to look at the most recent inflation data. I know that last month, both inflation indicators stepped down unexpectedly. My view has been I'm just going to sort of look through that until I get a better reading as to whether or not it's altered its trajectory, as you're suggesting, or if it's just sort of a little pause like that. So I think it's going to take a few months to sort of sort this through. I will say that I have been a bit cautious, nervous about inflation. I think it's extremely important that the Fed be able to get our inflation data up to our inflation objective of 2%. And I think that we have a symmetric inflation objective, so that we should be on either side of 2% most of the time, and we need to get it up.
The conversation that you've just had downstairs was, I thought, very relaxed, very convivial, and you said, look, I don't know whether we'll spend as much time above target as we did below target, but when I look at what the market is expecting, there's still this broad difference between what the Fed expects from rates in a couple of years' time and what the market expects. The last time Bloomberg caught up with you, you were 2 rate hikes for 2017. Do you still stand by that, given the temperance in the data?
Well, my outlook hasn't really changed that much. I think, if anything, maybe it's, well, except for the first quarter data was weaker than I would have hoped for, certainly. We're kind of looking for the second quarter to make up for that, so it averages back closer to my 2.25 rate increase. I am mindful of the fact that for many years we've started off thinking that growth would be stronger, and by the time we were finished, it was a little bit lower than that. So, but the unemployment rate's at 4.4%. We've had strong employment growth for quite some time. This ought to support getting inflation up to our 2% objective, but I do think that we need to get it to 2%.
And you were very clear about that is our mandate, along with full employment. But the debate around wages, and you mooted the discussion around slack when we were down there. But if I look at the wages data, and again, this comes back to, it's a little bit like the CPI data, a little bit of a question mark the market will put beside it. The wages data, 2.5%, does that muddy the path to the higher land of rates for the Fed?
Well, I think that, yeah, right. So I think, normally you would, sort of hope that wages would be growing in the 3 to 4% range. Inflation target of 2 plus productivity growth, you get sort of 3 to 4%. Not quite sure which one, dominates that. We're at 2.5, 2 3/4, depending on the measure. They say that it's difficult to find workers with the appropriate skills. You would think that that would lead to skills being bid up even more than that, and yet it's been
it just
somewhat
hasn't happened
reduced.
That way.
So, I'm hopeful that it's going to move up. I think that resource slack has certainly been eroded quite a lot. We're probably at 4.4%. Arguably, we're at full employment.
Let's talk about that full employment. We probably don't have enough time in this entire interview to get into the nuances of what full employment is. But one thing that struck me was a 10-year low for unemployment rate. Is the natural rate of unemployment fit for purpose? And does that have implications for the Fed?
The median Fed participant has 4 3/4 is their estimate of sustainable unemployment. I'm actually on the lower end of that. My staff has looked at demographics, and possibly 4.5% could be full employment. There's sort of a concern maybe that inflation pressures are non-linear as you go below the natural rate of unemployment. So maybe we'll all of a sudden see Phillips curve inflation contributions pick up a little bit more if we keep moving down. I don't know, but we'll be mindful of all of this. I would say that getting more people into the workforce, employed with time on the job, building skills, ultimately has a longer-term productive effect. There have been people, out of work for quite some time, and they would benefit from this. And so I think it supports stronger growth in the future as well. But we do have to be mindful that undershooting too much can come with additional costs.
Those additional costs could cause some concern. Governor Kuroda over at the Bank of Japan, he used a phrase this week. He talked about animal spirits and escape velocity. When I look at the certain data points that we've discussed so far, give me your phraseology for U.S. recovery so far, because there's a flashing light over that backward-looking GDP in first quarter. Escape velocity, is it there? Is it on the table? Is that what you sense in the U.S. recovery?
Yeah, so if you go back to 2011, 2012, 2013, I just kept saying we need to achieve escape velocity. We need to get growth up. Unemployment, at one point, we're facing 9%, 8%, 7%. But now we're down at 4.4%. We blew through that escape velocity, and we just sort of had, steady, lower than what we would have hoped for growth. But it kind of worked out. As it turns out, it took longer. Would have been better if we'd gotten there sooner, but monetary policy could only do so much, and we would have benefited from additional other policies that help stimulate that. Here's where we are. I think we're very close to full employment, if not at full employment, and so escape velocity beyond this is just very difficult to achieve stronger growth. First quarter was weak. Second quarter might make up for that. I think that over the second half, we're going to, see those 2.25 growth dynamics reemerge. That's my expectation.
Let's see what comes through, I suppose, from the fiscal side from Congress.
There's that too. Yes, that's right. So it's difficult to have a strong assumption about fiscal policy. It could be extremely strong if the tax cuts, as the Trump administration have proposed in the one-pager, or if it doesn't really take place, or if something much more muted and it takes longer to implement. So there's an awful lot of uncertainty. It's very difficult to put that into any forecast.
Briefly before we move on to balance sheet reduction, which the entire market is out there waiting to hear from you on that. But if we look at that, the risks to U.S. recovery, do you think they're bigger domestic risks than there are global risks? If I say fiscal risks versus global risk, how do you look at the world? How do you look at the risk?
Well, I think the U.S. economy has sound fundamentals right now. So, it's difficult to come up with very many downside risks there. If anything, the fiscal policy would be upside risks in terms of growth and pushing unemployment even further down, which, could have its benefits, as I said before, but you can overdo that. I think that the global environment is much more sound now, actually, and so I've been nervous about that, but I just can't discount the reports anymore from business contacts that say that Europe is doing better. It's better across the board. It's growing from a low level, and there's quite a ways to run beyond that, but things are going better, and I think China can shore things up as well.
Now, there's one word which is pervasive from all of the Fed speakers, and it's gradual. And we're talking about the balance sheet reduction, that discussion. When I look at the balance sheet reduction, it's the three words that strike fear into every bond trader's view, which is balance sheet reduction. You're not in charge of the bonds that you bought, that you have got on your balance sheet right now. In terms of when they mature, there's a whole hodgepodge of them.
That's right.
What do we need to hear from the Fed in terms of, it's about $450 billion rolling off next year. Do you need to begin to tell us, look, we're going to have a steady momentum program. It's going to be month by month. Do you think that's what we need to hear from the Federal Reserve when that discussion comes about?
Well, so the Fed needs to articulate our strategy for monetary policy. Beyond just achieving our objectives. And at the moment, we have a very large balance sheet. We have been increasing the short-term interest rates. Now with increased confidence, I would say that we can confidently point to an upward sloping futures funds rate path, the SEPs. You did mention that the markets have a slightly lower path, but I think that our path is more likely to be the one that we
Stick
actually
by your dots.
Follow. That's correct. And I think that to accurately capture the stance of monetary policy, you do have to take into account the stance of monetary policy. The stance of the balance sheet. So, we've indicated that once funds rate increases are well underway, an artful term, that will begin to renormalize. And so, we've said in the March minutes that most participants expect later this year to begin this adjustment to the balance sheet. We're having discussions about what the right size and pace of reductions, how it will be conveyed. I would say that I know that I am mindful that we don't want to disrupt market functioning, but we want to be careful and confident that we're going to display a downward sloping path. It might take 3, 4, 5 years to get to the point where we then begin growing the size more in line with the economy growing. But once we get it confidently moving down, it can kind of recede into the background, and any adjustments in monetary policy can be taken with regard to alterations in the funds rate path.
The other discussion is this. Look, there's a wonderful piece written by a gentleman called Noel Carr that there are bad times just around the corner. if we look at the reality of economics, there's always ups and downs, and it's cyclical. There will be another rough and tumble period of time in American economy. Is it that you still want to have QE as a solid arsenal piece, or do you think the market is too demanding of QE to be a fixed facet of the arsenal of the Fed?
Well, I think we need to be mindful of the fact that we've adopted a 2% inflation objective. The world seems to be one where real interest rates are much more likely to settle in at about 1%. Put those two things together and you've got a eventual funds rate neutrality at 3%. At 3%, there's not a lot of scope to cut interest rates when you find yourself needing to provide more accommodation, when you're hit with shocks. You know, on average, we've been cutting the funds rate by about 500 basis points or more in order to make adjustments over a long period of time. So, you know, we are much more likely to hit the zero lower bound if we are hit with shocks. How should we prepare for that? Well, one thing, we need to make sure that we can at least get the funds rate to its, you know, neutral level in accordance with the fundamentals of the economy. When the economy is ready for it, we're at the neutral level. Then we can have some scope to cut, but it's also the case that if we hit the zero lower bound and more is needed and other parties aren't willing or able to provide the accommodation, we would need to use other tools, and QE is another tool that we have used with some effectiveness in order to improve borrowing conditions for businesses and households at the long end. So I would expect that if we hit the zero lower bound and we need to do more, we will in fact turn to those tools.